This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Welcome to the program, ladies and gentlemen. My name is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents, now in its 1,500, 1,600 episode, something like that. Lose track of it after all of those many years. It started back in the late 80s by my father-in-law, Jack Nelson. The trend or the tradition continues today by me, yours truly. The program, Dollars and Cents, aptly titled because it's where we make sense out of all of those different decisions that have anything to do with your dollars. On the program today, we've got a litany of topics that we'll tackle. The one of them is going to be a discussion of when, in fact, you have to pay taxes when you inherit property or assets of any kind, for that matter. Oftentimes, there is this confusion, I guess, between estate taxes or income taxes or just straight inheriting property. So we will attempt to try and remove some of that confusion out there. And certainly, speaking of confusion, there's a lot of confusion still out there on the rules that apply when you sell your primary residence. And there was a very traditional rule on this one that was around for decades, but now almost 20 years ago, it doesn't seem possible, but 20 years ago, the IRS still sort of changed the rules on it. And you would be amazed at how many people still operate under the impression that the old rules from 20 plus years ago are still the current rules. So we'll tackle that. And then if we have time, we will tackle the age-old question, how do you make up for lost time? Was visiting with somebody this past week, and they had kind of put everything on pause for the past 10 years from an investment perspective. And so how do you begin to make up for that lost time? The answers are not pretty. So perhaps if you've put your investments on pause, you may want to listen up to that topic. As we get deeper into October, one of the deadlines that is coming up is your taxes. Your final day to file taxes is October the 15th, and certainly in the office we get most of the returns that we do for our clients done by April 15th. But there's always some stragglers, whether it be just procrastination on their part, which is often the case, or just simply more complex issues that need more time. In this particular case, it was probably a combination of both. But I was looking at this tax return last week, and here's the part that struck me. So just how, I guess, convoluted, we'll go with convoluted, the political system has been, and how everybody tries to grab labels. So this is from a Minnesota income tax return. Now, here's the good news. Here in Florida, we don't have to worry about that, or at least well, yeah, we don't have to worry about that unless the politicians decide to change that. Hopefully, they're smart enough to not do that. Anyway, so I'm looking at this Minnesota individual tax return, and the whole reason that this person had to file it is because there was an inheritance out of the person that passed away was living in Minnesota when they passed. So we got a common theme about what to do when you inherit assets on the program today. And so I was looking at this Minnesota, tax return. So you have to appreciate where we are in terms of this tax return. And it has a provision called the State Elections Campaign Fund. If you want $5 to go to help candidates for state offices pay expenses, enter the code number for the party of your choice. Okay, that's something that appears on the federal return as well. What struck me as I was looking at this Minnesota return is just how many different political parties they have up there and how ridiculous some of them are titled. We'll go through the list. Republican. Okay, well, I get that. That's traditional. Democrat/farmer labor. Wait a minute. Is that saying that if you're a farmer or a worker, then you automatically are part of the Democratic Party? Really? That's what it says on the tax return. Independents. Now, here we go. It gets more interesting. Grassroots legalized cannabis. Apparently, that's a political party in the state of Minnesota. Followed by Legal Marijuana Now, another political party in the state of Minnesota. And then the Green Party and the Libertarian Party. So Minnesota's got two different political parties that basically want to get high. That's fascinating. And I guess that's where. And how did the Democrats manage to get the /farmer laborer label on this tax return? I mean, that struck me. It struck me as kind of an odd setup, if you will, on a tax return, particularly as I'm looking at these political parties. I guess that's where the political system is these days. Perhaps more so in Minnesota than Florida, but that struck me as kind of odd, kind of funny, and we thought we would share it with you. Speaking of odd, it never ceases to amaze me how many people still believe the old rule involving the sale of your primary residence. And it's funny because the rule changed like 20 years ago, but yet nobody, or there's a lot of folks that don't appreciate how this rule has changed. So we'll start by the old rule, just so you can compare and contrast. So the old rule, when it dealt with your primary residence, your primary home, it allowed you to basically keep buying a bigger home, okay, as you kind of get older and your family expands. Then, the normal course is to buy, a bigger home, right? And there's only one person or two people, then, and there's a bunch of kids, then you wind up going and buying a bigger home. And so what happened is, under the old rule, you could continue to sort of roll whatever the capital gain was on that property over to the next house. So let's say you bought house one and you bought it at $100,000, and then you sold it for $200,000. You had a $100,000 capital gain. You didn't have to report that. You could just simply take that over to the next house that, in theory, you bought for $200,000, or maybe it was $250,000, and then that becomes embedded, or that gain sort of becomes embedded in that next property, and so on and so forth, until such time as you were allowed to sell the house and then avoid the gain. Typically, that was a transaction that was done at retirement. And so that was the old rule, where you had that one option to get out from under the gain that you've been accruing all of those many years. when you sold your primary residence. When we get back from the break, we'll explain why that did not work and why the IRS changed that rule nearly 20 years ago. And we'll get into all of that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is your host, Joel Garris of Nelson Financial Planning, and we're talking on the program today about comparing and contrasting the old rule, which many people are still under the impression still exists, and the new rule that actually was put in place 20 years ago, so it's not so new, but the rules that relate to when you sell your primary residence. So to recap, the old rule, which we were talking about before the break, it allowed you to sort of keep rolling the capital gain on your primary residence as you bought bigger and bigger houses, as is traditionally sort of the pattern over the course of one's lifetime. And then, again, the old rule allowed you to do basically a downsize one time and sell the property and not have to worry about the capital gain, and then buy the next house, which was smaller, sort of that downsizing transition, and then you didn't have to report the gain. There were two things wrong with that. Number one, the assumption that you always buy a bigger house along the way may not actually be a fair assumption. Number two, the assumption that you downsize may not be a fair assumption as well. I mean, if you sell the home and decide to move over to the beach, well, the beach place might cost you more than, even though it might be smaller, than the house that you're selling. And then number three was just the simple logistics of trying to keep track of all of that. So the IRS scrapped all of that. The notion of rolling over the gain and then having a one-time opportunity where you can avoid the gain and downsize, that is gone. That's been gone for 20 years. The current rule is very different from that. The current rule looks at the amount of gain and says, if it is less than $250,000 for a single person or less than $500,000 for a couple, we don't care. You can fully exclude that gain on your primary residence. Now, the one caveat is that you must have lived in that property 2 years during the course of the last 5 years, measured from the date of sale. So if you had the date of sale, let's say the date of sale is October the 1st, 2018, then going back to October 1, 2013, at least 24 months during that 5-year period of time, you had to live in the house as your primary residence. If you did, then assuming the gain is less than $500,000 for a married couple, less than $250,000 for a single person, then you're fine. You're good. You don't have to worry about reporting that gain. And here's the thing. You can go and do it again. Like, say you buy the next house and the real estate market goes up and you sell, as long as that you have not taken advantage of this particular exclusion of capital gain within a 2-year period of time, then you can do it again. Basically, you can wind up doing it every couple of years. I think over the course of the past 20 years, did it on the house in D.C., and then did it on the first house here in Orlando. So I have taken advantage of that. It's not really taking advantage because it's actually the rule. So I have followed that rule involving the sale of primary residences twice, and I don't know that I'm lined up to do it a third time anytime soon because the kids are still hanging at the house. But the primary residence rules and the sale and how that works out, very different than what they used to be. And yet, even though that rule change happened 20 years ago, still a lot of folks operating under that impression of if I sell my property, I've got to turn around, I've got to put it into a smaller property, or I got to turn around and put it into a bigger property. No. Not true anymore. You calculate the gain. If it's less than $500,000, then you're perfectly fine as on a joint return. Less than $500,000, then you're perfectly fine. You don't need to worry about. The only time you got to worry about that is if the gain is over $500,000, then you're going to have to report and pay taxes on that. Or if you're doing that too often, meaning that you're doing it every year rather than no more than every 2 years. Of course, if you're doing that well on your real estate purchases, then you're doing really well. But I don't think anybody's doing quite that well where they're making $500,000 every year on their property. So just know that those rules have changed. Those are very different than how they used to be. And in fact, that change has been around for a couple of decades now. So just be aware of what those rules are. Another common misconception that we see an awful lot on is when taxes are due on inherited property, and how does that work out? There's either you're in the camp of you think that there's no taxes due on anything, or you're in the camp of there's taxes due on everything. And the reality is that it's sort of a combination of both of those, and how much of the taxes you have to pay depends upon what type of an account we're talking about. Now, income tax is different from inheritance or estate tax. Inheritance or estate tax rarely paid in today's world, simply because the estate tax exemption per person is north of $5 million. So for a married couple, the combined estate has got to be well above $10 million in order for there to be an estate tax or an inheritance tax. So understand, though, if there is, then typically the estate is going to pay that before the money ever gets to you. So when you inherit money, you really don't have to worry about the estate or the inheritance tax, because that's really a responsibility of the estate to pay, or the trust to pay, or the executor to make sure that that's getting paid, and not you as the beneficiary. So be aware that that's not anything that you need to necessarily worry about, because that should have already been taken care of as part of the normal estate process. What you've got to worry about then is, okay, what is it that I'm inheriting, and what fundamentally are the tax implications of that? So we'll start with tackling some of these categories. For example, on a property. Okay, so on a property, let's say your parents pass away, and you're looking at the investment property or some other property that they had for 20 years. Well, the good news on that is that there is something called a step up in basis. So even though they may have had a big internal gain on it, that if they had sold it, they would have had to deal with the tax repercussions on it, because they passed away, there is something known as a step up in basis, which basically means that if they bought the property for $100,000 and is worth $500,000 today, if they had sold it, then they would have a $400,000 gain. However, if they pass away, the basis, that 100,000 number, steps up to the value at the time of death. So that steps all the way up to that 500,000 number, which means that if you turn around and sell it, then you're not going to have to worry about a gain of any kind on that. So that's how the property side would sort of work, given that step up in basis concept. There's a lot of other things, though, out there besides just that, that people can easily be inheriting. And so we'll talk about some of those other things and what the tax implications are when we get back after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also still simulcasting over there on 540 AM, so we like to always say hello to our AM listeners as well here on the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, and we're talking a little bit about what happens when you inherit assets. And so there's this common misconception out there that you've got to somehow pay estate or inheritance tax or whatever, and generally that is incredibly, incredibly rare given the estate tax exemptions that exist out there today. Those are well above $5 million per person, so very rare to see that ever come into play. And the reality is that it actually, to the extent that there is an estate tax or an inheritance tax due, that has to be paid at the estate level so that the assets that you then get are sort of after that has already been paid anyway. But the real question is, what's the tax nature on the assets that you do receive, and how does that play out? Because depending upon the type of asset that you are inheriting, you might very well still have a tax liability. So it's never going to be free and clear. It really depends upon free and clear of income tax implications. It really depends upon what it is that you're inheriting. We gave you the property example before the break. Another example, of course, is pure life insurance. Life insurance and the proceeds from life insurance, if you're the beneficiary, always tax-free. Now, contrast that with an annuity. An annuity, assuming it's a non-qualified annuity, which means that somebody put some money into it on an after-tax basis, the profit on that does have to get paid and treated as ordinary income. So let's give an example. So if someone had $100,000 sitting in their checking account, your parents who passed away had $100,000 sitting in a checking account, and they put it into an annuity because they wanted to get a little bit more of a return, and someone convinced them that annuities were somehow, safer and had an insurance to it and all that nonsense that people get sold on in annuities. That's my view on annuities is, that's a different radio show, but let's just suffice that we're not a big fan because we think they're pretty expensive. They lock people's money up, and, the fact that they're the highest commission product in the business seems to us one of the biggest reasons why they are sold more than actually used as a viable investment product for someone's future. But anyway, there's the digression on annuities. Let's say, though, that you wound up inheriting an annuity. $100,000 was put in. Value today is $150,000. On that type of an annuity, you're going to have to report and pay the gain as ordinary income on your tax return. That's why most annuities will give you the option to pay it out over a 5-year period of time. That's fine. The reality is that you still are going to have to deal with the first dollars on that annuity that are coming out are the profit dollars, which means that those are the dollars you're going to have to report and pay income taxes on. So there's no way around that. There's some options typically with an annuity to defer it out over a period of time, but even that might not be the best decision even though the taxes might be a little bit lighter. If you're only going to have that annuity just sitting in cash, right, then perhaps you pay a little bit higher taxes to get that money, and to get that money, in fact, working for you rather than sitting inside that annuity only making 1 or 2%. Yes, you're saving on the taxes by spreading it out, but you are costing yourself on the potential for investment return. So just be aware, you can probably spread the taxes out on that, but depending upon the type of an annuity it is and the type of options you're getting offered as the beneficiary, you really want to take a close look at those options to make sure that the balance in the contract continues to stay invested so that you can make more money over that payout period. Or if it just simply gets dumped into effectively a 1 or 2%, then maybe you do wind up paying the higher taxes to take it all out at 1 year rather than spread that out over time. So that's kind of how the annuities work. You've got to understand what the underlying basis is in that annuity, and then the difference between that value and that basis, that is all ordinary income that you're going to have to pay taxes on. So be aware of that on an annuity. Very different from straight life insurance. Straight life insurance is always tax-free. Now, any other type of an account that is sort of non-qualified or after-tax dollars. So let's say your parents bought ExxonMobil 30 years ago. Obviously, there's a huge gain on that. Again, that gain disappears because of the step-up in basis equal to the value at their date of death. So in those cases, don't have mom and dad sell ExxonMobil if they're up into their 80s, right? Because the reality is that if they sell it, they're going to have a capital gain to report. If they pass away, that gain completely goes away. So that's pretty powerful stuff when you start to think about, okay, what assets do I need to use for my parents' care as they're getting older? What are the tax implications on it? And in that particular case, if you've got something that's got a big gain and you're able to kind of set that off to the side and use other assets, then understand that gain goes away when they pass due to the step up in basis concept. The last typical account that you'll see people getting inherited is, of course, some type of an IRA, 401k, 403b, or what have you. Let me be very clear on this one. One of the biggest reasons why you want to take your old employer 401k or 403b and roll it over to an IRA is that the IRA does, in fact, have more options to stretch out the distribution of that money over a long period of time. A long period of time, meaning the rest of the beneficiary's lifetime. So be aware, though, 401ks, 403bs, they don't necessarily have the stretch provisions that are standard in the IRA. So that's a primary reason why, along with the fact that most 401ks and 403bs are getting pretty cookie cutter on their investment choices with all these target date and allocation funds, it is still one of the biggest reasons why we say when you leave your employer, 401k, 403b, rolling it over to an IRA is a great strategy, because then that frees up that money to be used in a much more tax-flexible manner. And in particular, for your beneficiaries, it gives them more options as well in terms of how they're getting that money out. So on an IRA, you do have a few options if you are the beneficiary of it. The first option is the usual option with any of those types of accounts, which is I can just cash it all out. Well, in that particular case, you may not want to do that because you're going to have a full tax liability on that. And in contrast to the annuity, you should be able to have those IRA assets invested even on an inherited basis. We'll talk more about that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 93.1 WFLA. Covered a lot of territory in the program today. Opened up with, I guess, a funny commentary on what I saw on the Minnesota state tax return in terms of the number of political parties. They've got like two parties that are trying to legalize marijuana. I mean, it's like 9 different political parties up there. It's kind of crazy. And the reason, of course, that we're looking at a tax return is that there are still some stragglers out there. So if you're in that category, know that you've now only got a few more days left. October 15th is the final deadline to file your 2017 tax return. So you better get on it because now you're really running out of time. From there, we spent some time talking a little bit about the rules for selling your primary residence. A lot of people still stuck on the rules as they existed 20 years ago. Not the case where you just keep rolling over the gain and you get a one-time opportunity to sell and downsize, and then you avoid all of the gain that you've accumulated over time. That rule, that old rule, was far too difficult to track. And so the new rule, which started about 20 years ago, effectively allows somebody, if you've lived in the house for 2 years, particularly 2 years of the last 5, then you can exclude a capital gain on the sale of a primary residence up to $250,000 as a single person, up to $500,000 as a couple, and you can do that every 2 years. So the exclusion is much, much broader and much easier for most people to effectively fall into. And then now we're talking about what happens when I inherit stuff. We went through all of the different incarnations of the different types of investments, property, life insurance, annuities that you can inherit. And in this segment, we're finishing up the last one, which is an IRA. And so with an IRA, the first option you have, which we talked about before the break, is you could certainly cash it all in. The problem with cashing it all in is that you've got to pay taxes on the full amount. Now, understand that when you cash in an IRA that you inherited, there is no 10% penalty at any point in time because it's an inherited account. So the 10% penalty that would typically apply if you were not age 59 and a half never applies on an inherited account. So be aware of that. Now, with an IRA, in contrast to some of the annuities out there, an IRA, you can, in fact, keep that invested. So that allows that money to continue to grow. And because it's still inside of an IRA, it's growing on a tax-deferred basis. So that money that you inherited can continue to grow on a tax-deferred basis, which is a pretty powerful compounding vehicle. Now, the caveat is that if you have such an account, then there is a required distribution that you have to take out of that IRA each and every year. That's the only part that you're required to take out. How much you're required to take out is a straight calculation based upon the value and your age, and then you calculate out the number. It generally is around 2, 3, 4%, depending upon how young you are and how old you are. Obviously, it's 4% if you're older, it's 2% if you're younger. That then allows you to continue to leave that IRA untouched and continue to grow on a tax-deferred basis. So be aware of the different nuances that apply when you inherit money and whether the taxes will be due or when they'll be due or if you can push them off. And again, we're talking income taxes, inheritance estate tax, rarely seen these days with the estate tax exemption now well over $5 million per person. The reality is, even if there is an estate tax or an inheritance tax, that is generally held by or paid by the estate or the trust itself. So by the time the assets get to you, that's generally been all taken care of. Our last topic on the program is a tough one, and we want to kind of try and tackle it a little bit, or at least give you some food for thought on it. And that is, how do you make up for lost time? How do you make up for lost time? And folks, we see this. We've been talking a little bit about why now is sort of different, than other recoveries post 2008. A lot of that is because people are still holding tight to their money, and they're being conservative with their money, and that's probably one of the reasons why we think there's probably more to this recovery cycle post 2008 than what the lunatics on the mainstream media would have you believe. They think the end is coming tomorrow. We think there's probably still more room to go because you still have a very conservative mentality among the investing public. And we continue to see that on a regular basis as new folks come into the office. And the hard part is when you've been waiting on the sidelines for an extended period of time. Visited with somebody this past week, literally been waiting on the sidelines since 2008. That's 10 years of investing. That's 10 years of working towards a goal of retirement that you're not going to get back. And so it puts folks in a pretty difficult position when that happens, because all it takes is getting too distracted by the headlines and then losing track of the fundamental concept about investing is it's not necessarily about your timing. It's really more about your time in. So when you lose a decade waiting on the sidelines, that's pretty costly. And there's no easy answer for that, with the exception of, my goodness, you got to start now. I mean, you got to start getting that time in and get less fixated on timing and get more fixated on getting time in. Now, I'm not saying you just take and throw it all in on a random day. I think there's some strategies with dollar cost averaging, with trying to be selective on when as you invest money that are certainly worth doing if you're trying to make that move off of the sidelines. But to simply continue to wait without a strategy, that's not going to work, because the solutions to that are very hard. What are the solutions? Well, there's stuff that people don't want to do. It's stay in the house that you're in, okay? Don't upsize. Don't go, buy something over at the beach. Stay in the house that you're currently in. It's work longer, okay? And by working longer, then you delay taking Social Security so that you can get Social Security to a higher and higher number, because you've lost 10 years of growth on your assets, so your assets are not where they should be in order to generate out the right level of income. And as you start to work through these tough solutions or these tough answers to this problem, it should make you pause and say, well, I'd rather start to get my time in from an investment perspective, rather than continue to sit on the sidelines waiting for the right timing. It's just not going to work. The implications and the ripple effect, far too dramatic. You're going to have to work longer. Going to have to not get as big a house. Going to have to adjust the numbers in retirement. I mean, it's not pretty while you're waiting and trying to play the timing game. Stop it. Start playing the time in approach, and ultimately you'll be on a better path to retirement than waiting and waiting and waiting, because you're never going to be able to pick the right spot. The music means we got to wrap it up. We'll get out of here for this week. Thank you all for listening. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.